William asked a question, and in the last few days with the markets really ramping up a little bit, most stocks saw some ramp up, some saw some small ramp ups as well. But William says, short strangle adjustments. Okay, I'm going to be upfront with you and clear, William. The discussion I'm going to give to you right now on short strangle adjustments is going to be theory on what I would consider doing and how I may consider manage the positions. As many of you have heard me say in the past, I never trade personally short strangles or short straddles. I may do an iron condor, but I haven't actually looked at an iron condor trade since probably 2014 or 15. We ended up managing one side of the other too often, so we decided to ride the bull run and try to maximize the returns for the bull put credit spreads during those years after, mid 2015 and on. Doesn't mean they're bad strategies. I just don't trade short straddles and short strangles. I would do them as an iron condor to cap the risk on either side. So all that being said, that's not a bad one. AEM's up 4 points today. So let's do that. Okay. All right. So let's say I entered a short strangle on AEM. I know you're probably using much larger price stocks. You're looking at Netflix, maybe Amazon, maybe not, because of the margin requirement involved, William. But in any case, let's take a look here. A short strangle, of course, is a combination of a naked call and a naked put. Good range out of the money, 10%, maybe 8%, depending on how long or short term you're going. The idea is hopefully that the stock will remain in a trading range. The call and the put will expire worthless. You'll keep the whole premium. Now, an iron condor is a little different. We add the outside legs, essentially combining a bull put credit spread and a bear call credit spread on a position. Actually, let me do this. Let's do this real quick. Let me open up another window. I'm going to get the actual prices of what this was on Wednesday for my particular stock, AEM in our case. All right, so, okay, sorry about that. So let's just go to the chain for AEM. And I want to go back 2 days when the stock was at 78, I believe, 76 actually. So we're just going to go back a couple of days here to the 7th, if it lets me. There we go. Yeah, well, oh, one more day, I'm sorry. Okay, perfect. So let's say when the stock was at 77.60, I entered a short strangle in the position. I wanted to go close to 10% out of the money, but still get a reasonable premium. It's going to be tough with this stock, but that's okay. And we're going to use just October 16th expiration in this case, William. 70 strike here, 5 to 20 cents, no, but that's 10% out of the money. So let's be nice to ourselves. Say we got 25 cents for the 70 call. I apologize, the 70 put on October 7th. And then 10% out of the money. Here's the 85 strike. But what I wanted to do is use the 80. I know it's close, but let's say that we use the 80. It's only 3% of the money, so you probably wouldn't have done this, but we're going to do it. All right, we're going to do a 10-point spread here, and we're going to collect $1.05, $1.10. There, so that's the 80 put. Okay. All right, so let's go back to our other screen. Sell the 70, buy the 80, sell the 80, do our short strangle position. And I said 110 for the call, and we're going to be nice to ourselves, say 25 cents for the put. There we go. Now, neutral, extremely neutral position. I know this return is rather small, but that's typically because we're showing the max margin requirement, okay, of the naked put and the naked call. Most of the time, your broker, I believe, will just charge you the margin requirement for the naked call plus the put premium. There's other calculations that may be used if you're using a margin account as opposed to a straight leg here in that case, okay? So, but here's our strangle. And now the stock has moved up against us. It's gone above the short call. We started off, remember, with the 80 strike call and the 70 strike put. We probably would have gone 10% of the money, so we'd still be fine, hopefully, there as well. But in this case now, it's being violated. I don't know how many of you actually trade these other strategies such as this, but in my mind, without getting too elaborate, which could take on extra risk, depending on your outlook for the stock, now that the move has happened, you may just adjust this as you would consider adjusting a naked call position. Honestly, that's what's hurting the position right now. Your put's looking great. This is the one that's bothering you. How would you adjust a naked call position if it started to move against you? Well, just as you might do with a covered call, if you didn't want to be assigned, you're probably going to consider rolling up the position. So what does that mean? I'm going to have to buy to close this 80 call for about $3 now. We took in 135. So I might have to consider buying to close this. Can I roll to the 85 here? No. That's only going to give me 80 cents. I'm down 330. $2.10, $2.05 roughly, because remember we took in that 135 to begin with. So that doesn't put me in profit. That puts me at a guaranteed loss, even if it stays between 70 and 80. I haven't made up the premium of this buyback cost yet. Okay. So I need to find an out of the money call that I feel is 10% out of the money, but is still going to give me that additional $2 or so I need. Let's see what it would be. Oh, I added it twice. My apologies. Midpoint's 340, 205. Now the put's essentially worthless at this point because it started to move against me. It moved up against the short call, I should say. So my put's going down here. So I might be able to buy this back for 5 cents. So let's call this 210. Why would I buy back the put as well if it's working? Because I'm likely going to have to go out to November or December, maybe further. Even if this had weekly options, I might even have to be going out to November or December standard expiration to get the 205 credit I need if you're trying to stay in the strangle structure. All right. So this is just, option one of probably a few ways to label this, and I'll get to that in a moment, William H. But let's just do it. Let's just buy back the whole thing, close it out. We know we'll be at a cost of, wrong one. We know we'll be at a cost of about 210. Okay. All right, so 210. So now what do I need? I need to look out November. Okay, not bad, but there's a lot of risk here. Why is there a lot of risk? Let me talk about that. I need 210, but this is a stock that's been moving up the past 2 days. Different market conditions, speculation or exuberance over talk and increasing talk of a stimulus coming out. I need to give myself a lot of room, but I need that 210. So I think if it is still going up, maybe the 70 to 95. I get about 145 here, get about 90 here. So that might put me in a position to counter the 210 loss, right? So let's clear this out. And we're just going to sell one. We're rolling the whole thing out to November. Okay, so we get 242. But remember, this is not 242. This is 242 minus 210. We're really only getting about 32 cents of profit. Okay, that's a repair. That's one repair. Okay, so 32 cents, 0.2% based on that entire margin requirement that for the naked call, and for the naked put as well, William. Now, is this better than taking a loss? Perhaps. This is not an adjustment I would consider, though. Why? Because you're likely going through two things right now. Last week, we posted a little video. I've almost got it finished. I was going to record it today, but I didn't get a chance to. But we called it EAP, the risks of buying calls or buying puts in this market. But this also refers to positions such as this and iron condors in this market. Why? Because we're going right into earnings. We've got an election coming up here in the US. And of course, we still have up and down little market movements based on the current pandemic that is still going on. And as we saw, discussion of who's doing what stimulus-wise, market-wise, how is it affecting airlines, who's getting furloughed next, Carnival cruises, things of that nature. Market swinging up and down on these little news tidbits that are coming out. So what does that mean? That means the market's going to be fluctuating with this different news, known events coming up with unknown outcomes. Now, although that leads into a greater volatility, which the first part of this discussion that we posted the first 7-8 slides of last week when we went over it, there's a risk of buying calls and puts, because if your stock doesn't have a good earnings and stays flat or only moves up 1 or 2%, you're going to experience a volatility crush of maybe half of what it is now. And if your earnings are on October 27th, you don't see the move that you want, 6-7 days later, you've got the election. And the market's going to react on the 4th, perhaps, based on what happens with that. And then the volatility will fall again. That would work for selling into premium, maybe an iron condor where I'm going to short strangle, but it's also going to come with various fluctuations up and down that could be drastic, that even if you get the implied volatility, you're on the wrong end, one way or the other, of that high infinite risk for the naked call and the naked put side of the position. But this is a repair that could potentially be considered. Now, you might be asking yourself, well, what about, no, I don't think anyone's asked this yet. I saw a couple comments come in or a couple other questions come in. Okay, they weren't related to this. But again, if we go back to the original position, you'd say, okay, well, what I'm really asking for is how can I repair my position as it stands right now? In this case, for this expiration. And the answer with this structure is you can't. Okay, there's not a lot of things that I can do with only a few little bits left to expiration. The danger here is that you can price yourself out of it so fast. If this keeps going in this direction, any type of repair you could consider if you let it go too far is going to be out of the question, unless you want to roll out to February or March of 2021 to try to repair the premium. Now there always begs in that question, well, can I convert this to some kind of broken wing butterfly? Can I convert this to some kind of ratio backspread? Can I use other options to repair this? And the answer is yes, but at what cost? In other words, to repair this, what's losing now? The short call. If AEM keeps going up, could I turn this to a profit to the upside? Sure. I could look for some cheap, out-of-the-money options 7 days away. 90 strike calls, perhaps. Let's buy 2 of those. This will create that sort of broken wing butterfly you were talking about. In a sense, it's a different structure. Okay, so now we've got this lovely little profit and loss chart that can profit to the upside. Okay, if what? If the stock continues up above 98.90 in the next 7 days, or if it falls back into this range. If it keeps going up, you're taking a potentially larger loss than you were initially. Can I cap the gain here? I'm sorry, can I cap the loss here by just buying one call in this structure? Yes, you can. You'll have a bear call credit spread with a capped loss to that side, and still the naked put open. This might actually even reduce the margin. Now it wouldn't, because you still got, now I've got a 10-point spread to the call side. Okay. Yeah. So now you've capped it, but what's the issue? You might end up losing more here because you haven't addressed what's losing, and that's the short call. That's why when I talk about short strangles, when I talk about iron condors and someone says, how can I manage this position? It's moved up against my short call. It's moved up against the bear call side. Even if I'm in an iron condor that had that capped upside loss to begin with, still a loss, I got to focus on doing something with a short call, because that's what's hurting me. That's what's going to continue to hurt me. It's not the long option out here that's hurting me. That's helping me. That's gaining in value. The negative value against me is what's hurting. So you've got to find a way. You've got to find a plan to adjust this short call, whether it's just rolling it out. But again, as we saw, this shorter time frame to October, this strangle position, you couldn't get enough premium. You'd be locking yourself into a loss no matter what the stock did next. You'd have to likely move the whole spread out to November if possible, December if necessary. With AEM, we saw the December series isn't available yet. That's going to come out after next week's October expiration. Okay. Or could you convert it to that butterfly? Yes, but now you've increased the benefit of getting to that break even so high. Why didn't I use the lower strike call instead of the 90? Why didn't I use those lower strike 80, 85 calls? It's because the premium was too high to where I'd see a profit maybe if the stock went up to 91 or 92 if it continued up. But then this whole section would have been a loss to the dip, and then the break even way up here in the 90s. Still, just not at 98. Would have been maybe at 91 or 92. But then if it pulls back, did you get any benefit here? No. You've locked yourself into a loss where it could have been a profitable position in this case. So, opportunities here. Can you hedge the loss by buying a call on the side that's losing? Yes. Could you buy an in-the-money call? In this case, with the stock moving up, could I buy a lower strike call than the one I've sold to create a bull call debit that would profit to the upside? Yes, but it likely won't give you to a profit because it's going to be close, too high of a cost, right? So we sold the 80 already and that got violated. What if I buy the 75 now for 760? Remember, my initial net credit was only about 120. So if I buy this for 760, that's going to put me at a cost basis of 640, but the bull call side is a 5-point spread. I can only get 5 points back, which locks me into a loss of 225. I'm sorry, 140. The max loss is negative 140. That's my best case scenario, is lose 140. And we saw we could close it now and take a loss of 110. I might as well just close it now and get out of the way of the freight train if I think this run is going to continue. So that's why it's sort of risky to try to do elaborate repairs inside the short strangle position to complicate it and not give any benefit. As we saw right now, I'd be better off closing the short strangle and only taking a loss of, I say 110 or 210. I'm sorry, I think it was 210. My apologies. It was a loss of 210. I could do this to lock in a loss of 140, but if I just close it out now at 210 and roll it to November, I could be okay. But now what's the broad market doing? Yeep, earnings, election, pandemic still going on. Might not be the right time to have a neutral strategy position such as an iron condor, iron butterfly, short straddle, or short strangle. The volatility and implied volatility is great for extra premium, but we know the market's going to be moving for the effects of earnings, news and ideas, and other warnings that are coming out, continuing with COVID-19, the pandemic, and of course, the election coming up as well. We're going to see some swings. It's going to lead to volatility, but as you saw, William, unless you take far enough out of the money, which may or may not have matched your return goals for this strangle, in that case, it might not be the trade that you want to do. You might be asking for more of these situations where you're forced to manage it. Okay, so what have I done here? Oh yeah, I cleared that out. Let's go back to square one here. All right, so depending on how far bad it is against you, depending on your outlook on the market, this went up. And if it went down, I might consider doing the same thing. I might buy a put, of course, to cap the loss to the downside if it continues down, but still putting myself in the loss. I haven't addressed what's losing. Might close both and have to move the whole strangle out if I want to stay in the strangle position. I don't want to necessarily overcomplicate it by trying to buy 2 lower strike puts or 2 higher strike puts to try to create that ratio in that position, because that might affect the whole position negatively where there's no chance of profit unless there is a huge, huge move downward. Okay, so real quick here, what I always like to do when we talk about these things, depending on how far it is, how far it's moved against you, and where your situation is, of course, number one, oh, and William, of course, this also applies to how much time you have remaining to expiration. So if I'm in this position and it was fine this week, but then Thursday of next week, it opens up here, I don't have enough time to really do any type of that elaborate ratio spread anyway. I've got to close this spread for the loss and try to figure out what I want to do going out further in order to repair it if I'm going to try to repair it on AEM. All right, so number one is do nothing if you think the market's going to pull back. In this case, I'm saying based on what my stocks did, they moved up, they gapped up last couple days. Thankfully, those are stocks that you see there in married puts, couple long call positions such as GOOS and others that worked out really well. But we're using AEM as an example going against us the upside. Number one is do nothing. We think it's going to pull back. We have a reasonable amount of time. You know the risk that comes with that. If it continues to go up, there's another 3% move on Monday. This position is going to look horrid. It's looking pretty bad right now, but it looked terrible. 2, buy to close the short only, buy to close the threatened side only. That's going to put you at the loss, but then you can choose to evaluate if you want to open a strangle on a different position that you're more neutral on, do a different strategy, but not maybe continue with this one because you were wrong on the stock or it's shown you something that you can't tell which direction it's going to go next. Number 3, close entire spread and roll out. Well, I'm sorry, let me put 3 this way. Close entire spread, take loss, move on. Make it back later on other stocks, other part of your trading plan. This one here we saw we took in a profit of 135, a premium of 135 is going to cost us about 330 to buy it back. So we're going to be at 340. I'm sorry. So we're going to be at a loss at about 210. Well, if I do another strangle that's 20 days out and I get another $1.10 and then another strangle later on that's $1.10, well, I've made back the 210 I lost. So maybe just move on and stick with your trading plan for other stocks that match the sentiment of this very neutral position. All right, close, take loss, move on. Close, roll, further out in time and in strikes. Close and roll, roll further. Let's put a little spiral here. Roll further to make back that. But of course, the risk there is you're going out maybe a month, maybe 2 months, depending on the stock and the premiums available and the loss that you've taken. And you're going through 3 events here that may cause a lot of wild swings in the market, which is not conducive to a short strangle, short straddle, iron condor, or iron butterfly position. All right. And 5, I mean, we showed some of those ratio ideas on the side that's losing, but really the benefit doesn't really work unless there's really more of a drastic move. We saw that break even was going to be 98.69, and this only has 7 days to go. Well, I'm in this as a married put. If AM goes to 98.79 in the next 7 days, I'm happy as can be. You'd have a repair on this position or a break even. But that's an extreme expectation. And I don't expect that at all in this stock. But again, those elaborate ratios, if you have more time and you've got less of a loss than we're seeing here, but if you have more time, that might work. This is probably too close, only 7 days away for that type of adding 2 extra long calls to put like a broken wing strangle of that side where it has infinite upside still going, William. That's kind of the risk there. So those are my thoughts on the short strangle. Again, in theory, not in practice. I told you, honestly, I don't trade these positions. If I did trade anything, of course, it would be an iron condor. So I would have had those, I probably would have done the 80-85 spread in that case. And the 70-65 here in that case for the iron condor position. Let's clear that up. But in that case, now if the stock's between the strikes, I might have been able to do a pendulum adjustment on the bear call side and had a naked put with a bull call debit spread, which might keep me at a profit if the stock continues to go this way. But in the short strangle, I don't have that. And the prices we saw is too much to buy that 75 call because it put us at that 3-tiered loss. Remember, we did sort of this thing. So that wasn't going to solve the issue. But if you called it soon enough, maybe before the short call went in the money, I might have been able to buy the 75 and the total debit now on that bull call side, including the premium that we originally took in, might have left this at a profit if AEM continued to move up against me. But now it's too much. And the cost of that 75 call and the difference in the strike prices here of 5 doesn't balance out the debit that we'd be in for the position, which is why it still remained at a loss in that case. It's kind of tricky to find those once this starts to move.